Chair now recognizes the gentleman from Arkansas, Mr. Hill.
Thank you, Mr. Chairman and the Ranking Member, for this good panel. Appreciate all of you being here and suffering a long morning with us. I've spent 35 years in the banking business, but prior to being elected to Congress in November, starting in Texas and in Arkansas. And so I've lived under all these rules and all these organizations for 3 decades and enjoyed every minute of it. It was a dream come true and prepared me for the running for Congress. Professor, you made a comment earlier that sort of left the impression, I think, that FDIC insurance is optional in some way. And since FIREA or FDICIA, I don't remember which, it's certainly not. It's contingent on getting a charter to be a bank in the country.
For getting a national bank charter, it is. For getting a state bank charter, it's not.
I don't believe that's true. And we're not going to debate it today. I just invite you to go check that out. I also reject the premise that banks sell bad loans on the secondary market and keep good loans for their own portfolio, which seems sort of implicit, kind of hanging in the room. I've certainly never seen that in my 3 decades of experience. I also reject the fact that somehow consumer protection was lax in the financial services industry prior to the dawn of a new world with the CFPB. We've had State's Attorney General, we've had insurance departments, securities departments, state banking departments. We've had the FDIC and OCC, I think, do a splendid job of enforcing consumer regulation in the commercial banking and credit union industries for years and years. And finally, I'd like to suggest that the burden of regulation is cumulative, and we never talk about that. We never reflect on that, and it's like that last straw that breaks the camel's back. And for me, something I'd like to point out is just the breadth of paperwork in the last 4 or 5 years. I'm so glad our bank went to our loan committee on iPads so that we didn't have to cut down more trees. But I got a note the other day from a bank in Searcy, Arkansas, in my district, for a $174,000 home loan. And prior to the ability to repay rules that are now in place, the package was this thick. And that comports with my memory of it from just leaving banking a few weeks ago. This is the size of the packet today, 255 pages, not including the appraisal, not including the tax returns, to go through a loan approval process, 255 pages versus 20 pages. So I think that speaks to what everyone is feeling, and all that cost is sent to the consumer, and I hope everyone understands that. The last topic I want to get your views on is this issue of disparate treatment that Mr. Williams raised, because we all want our consumers to get an absolute fair deal and a great deal from our financial institutions, be they bank or credit union. And we want that regardless of a bank's size, right? So the fair lending laws are good, and HMDA allows us to check to make sure we're doing a good job. But reflect on this one-size-fits-all, no price variability, no matter what your geography you're covering, in disparate treatment. Let's start with you, Mr. Fenderson.
Well, I would say that as we evaluate consumer loans, we try to evaluate them on an individual basis. And in many cases, we're dealing with someone that we've dealt with before, but when we're dealing with a new borrower, we simply evaluate their ability to repay and all the things that we normally have to check and balance for. We don't think that as an institution there's any disparate treatment to pricing a loan based on its risk, because your debt-to-income ratio may be higher than another borrower. So we'd like to retain that ability to do that.
Mr. Miller?
I would concur with Mr. Fenderson that we need flexibility to make appropriate business decisions. And if you look at how creditors have done in controlling risk, we've done a phenomenal job. And this one-size-fits-all approach, once again, forces us to major in the minors. We're forcing minor players in the industry to comply with rules that the major offenders have committed. And that's not fair for the consumer. It's not fair for the American people. It's not fair for the economy and jobs. And it's going to suck, once again, it's going to create this implosion of jobs in the financial services industry that also have a cascading effect and cause losses of jobs in other industries. And tax revenues will suffer from that as a result of that, too.
Congressman, disparate treatment, we are very concerned about this expanded HMDA reporting. We think that that is designed to be the new enforcement mechanism and the backbone for the federal regulators to enforce disparate lending on consumers, or excuse me, on banks. We have a lot of experience with fair lending in the past, and it is a very difficult issue when dealing with disparate lending, disparate impact.
Thank you. I yield back, Mr. Chairman.
Gentlemen,